My next guest is a numbers guy. He follows this type of stuff. He's America's accountant. Please welcome into the show, Mr. Dan Geltrude. Dan, thanks for coming on. You sent me a note about this over the weekend, and once I saw what you had to write about, it looked as though other people started to mimic you and were shooting around that word as well right after I got your email. So, what are your thoughts? I think you make a great case.
Well, Scott, I hate to throw around the word stagflation because I think it gets overused. However, we got something in the mix now that is a game changer. And of course, that's the war in Iran. Because when you start to have fuel costs impacted at this level, right? We're at over $100 a barrel now on oil. What does that mean? That means inflation is coming on. There's no question in my mind that the longer this war goes on, we are going to have inflation. If you looked at the job numbers we just had, not good news. And I know you've also been talking about the impact of AI on jobs and whether we're going to start to see high inflation. And of course, when you start to combine these things, which could lead to slower economic growth, well, you know what? We land right on that definition of stagflation. So I think it's time that we at least start having the discussion. Is it time to panic? No, but there's some warning signs there of some tough economic times potentially ahead here, Scott.
Yeah, you kind of summed up the rest of the show with me here, Dan, because I do believe, although there are some good things going on out there, that's only happening to the upper 20% of the incomes that are on that upper K part of that K-shaped economy, right? A lot of the other things we talk about are happening to the lower 80% of incomes. And I hate to tell you, Dan, throw stagflation in there, but I don't see it getting any better anytime soon for that K-shaped economy. I don't think it's going to rectify itself.
Well, we definitely have some challenges here. And as you know, all the different aspects of the economy are related and they all impact each other, Scott. So let's just look at, how the Fed is going to be impacted by this. So if we start to see inflation creeping up, which the way we're headed right now, that's going to happen. So there's a lot of contingent scenarios related to what happens in the Middle East. And we already know how uncertain war could be in a very unstable part of the world. So there's some real concern here because if we get inflation, then all the plans that the president may have or our incoming new Fed chair, well, now all of a sudden it's a different game. It's not an automatic to say, hey, we got to get those interest rates down. So if the interest rates stay high, again, it's another component of the danger of stagflation because that is going to mean slower economic growth with higher interest rates.
You're so right. And again, you're talking about the rest of the show for me here. You've got a friend, and I do too. His name is Mitch Rochelle. He talks about the housing market a lot on Fox. But I'm going to talk to Mitch a little bit later on in the show because you're talking about the Fed funds rate and what maybe say Kevin, the new Fed chair can do once he's in place. But you know what? The problem is that with this higher oil price and these inflationary fears, you've seen what the bond market's done. There might not be a case where we might lower the Fed funds rate, but we might not see that 10-year yield really do that much, which is what home buyers need to see break lower.
Yeah, that's exactly. And, we just saw that mortgage rates were coming down under 6. So that was great news. So for the real estate market, all we need is more supply. All right. All great. But what do you know? Now things are going in a different direction. But you know what I want to say, Scott, and being a little bit positive here, and I've made this case before. You have stocks out there, right, that just a couple of weeks ago were trading higher and people were buying. So let's be positive and say, well, you know what? We got some stocks on sale right now. So there's probably no better time to get back into the market. I always say these are opportunities. You should not get emotional and pull out of the market. You should be looking at the market will come back and I can make some real money here.
Exactly right. And I have also said this too, to your point. If it's just that easy to walk in the morning and see oil's higher, yields are higher, stocks lower, if it's that easy, then it's that easy to take advantage of it. And take advantage of it because we've got stocks like, the world relies on Microsoft for a lot of things. That was just over $500 not too long ago. It dipped below 400 just recently here. It's now back above 400, but it's still around that level. That's a 20% sale on Microsoft stock. When are you going to get a 20%? I mean, if you're looking to buy that tie and you finally get it on sale for 20%, you're going to probably buy 2 or 3 in different colors, right? People don't look at stocks like that, but you have Microsoft on sale for 20% off right now. What's your problem? Go ahead and put some on.
Yeah, and it's a strange thing because for some reason people get very emotional about the stock market, and that's the last place that emotion needs to creep in here. So to your point about, hey, something's on sale, you can't buy it fast enough. Now we know the stock market is going to come back. So if you can get these stocks at a discount, why wouldn't you jump all over that? And you want to know why? Because people have in their head they can time the market. There is no timing the market, people, right? It's time in the market. It's the long-term play. If you're in it, then stay in, and when prices come down, buy more.
Invest with optimism, not pessimism, because if you don't get in the market because you're pessimistic, you'll miss all these rallies, and that's the problem. Optimists, they're in all the time, and they are in the market for a long time. That's the time in the market, exactly what you just said. They're the ones that winner. All right, let's go to, thank you very much, Dan. We're going to go to these go-tos. Thank you very much for being on. Appreciate it. We'll see you again next week.